I want to welcome everyone. I am Clinton Wilkins. I'm a mortgage broker here in Halifax. I'm the team leader for our team in Nova Scotia. And under our brokerage, we have offices in Moncton, in Halifax, and Dartmouth. Last year, we did about 350 million for about 1,200 units. And this year, we're up, believe it or not, 40%. So I'm sure some of the other partners that we have on the call, we have some realtors, we have lawyers, we have financial planners, and we have a bunch of people on our team here on the call. I think they can probably also echo that this year has been weird and wonderful. I have made comments to our team. It feels almost like 2020 again, differently, but we have some of that muscle memory that we remember what it feels like, and we've been able to really forge forward. Made a couple comments here while we were letting people in that July and August maybe didn't feel as busy as last July and August, even though we're having a really, really good year. So it'll be interesting to see what September looks like and into the fall. I want to thank everybody for joining us for this webinar sponsored by BMO. We're really talking about what's going on here in Atlantic Canada. We're going to talk about rates, trends, home prices, and the economy. So I'm going to throw it over to Colin Steeves, and he will do a little bit of an intro. Thanks, everybody.
Thanks so much, Clinton. And my name is Colin Steeves. I'm certainly pleased and honored to be here, Business Development Manager with BMO Bank of Montreal. Have the lovely benefit of introducing Shelley, who's a senior economist and vice president with our BMO Capital Markets team. I have the benefit of hearing Shelley talk every now and then, and she's one of those people where it's like you hear her speak and you immediately get smarter. I think we're in for a really interesting presentation here. And I think as far as everyone's concerned, we're all partners here with Clinton's team. And, one of those things that we're always striving to do is, generate knowledge. And then it's also how you communicate that knowledge. And I think Shelley has that ability to provide, a certain local touch on what's going on in the economy today. And with that, Shelley, I'll throw it over to you. So thank you so much.
Sure. Thanks, everyone. Thanks, Clinton and Colin, for having me here. I don't know if it feels like fall just yet. It feels colder to me here in Toronto. It's 10 degrees outside. Definitely needed a jacket today. So hopefully, again, it's a little bit warmer where you all are. So like Clinton and Colin touched on, I'm a senior economist. My job is mainly to focus on the Canadian economy. And of course, I'll have a little bit of flair here for the Atlantic Canada regions, but I also hear we've got folks here from across the country. Unfortunately, though, I do need to talk about what's going on outside of Canada, because as you can imagine, it is affecting what we're doing every day. Now, I am going to do my best to try to limit the tariff talk, but like I said, to some degree, it's a little bit unavoidable. For all of our sanities, I'm not going to take us down memory lane because there's just been too much back and forth at this point. But it is important to know where things stand right now for Canada as a whole. We are, you could say, in a trade war, or at least trade tensions with our largest partner, of course, the United States. The US, essentially, the White House is looking to raise tariffs. They're looking to raise revenue. They're doing it for various reasons, depending on who you ask. But effectively, what that means for Canada, the US has made, now, from their perspective, they have made trade deals with a few key trading partners that do not include Canada right now. But essentially what they're trying to do is effectively create a baseline tariff rate of about 10%. So that's the lowest kind of tariff that they're giving to their, favorite nations, or nations that do not have a trade deficit, or from the other perspective, a trade surplus with the United States. So that is kind of the way, big picture, that they're kind of approaching their new trade relationship. Again, a tariff is essentially just a tax on a good that gets imported from another country into your country. So directly speaking, that just raises prices for American consumers trying to buy things that come from outside of the United States, which is a lot of things. That's one of the things that they're trying to avoid in the White House, is to, kind of bring manufacturing back into the United States. again, for Canada, so I did mention Canada does not have a trade deal with the United States. That's kind of true, kind of isn't true, because we do have the USMCA, which used to be known as NAFTA, of course, and that was a deal that was signed by the president in his first term. So it's been a few years now. And that is essentially what has been keeping Canada relatively insulated from this trade war. I'll get to actual numbers in a second, but essentially I've got a list here. Again, not necessary to go through the details unless anyone has specific questions, mostly because it's very easy to get lost in the weeds here. But effectively what we're going through is we've got this kind of top line number, this 35% tariff that the US is applying on all Canadian exports to the United States. Again, effectively speaking, we're pretty well insulated from that headline number because most of what we send to the United States is covered under the USMCA and is therefore exempt from that 35%. There are other things, though, that are not exempt, unfortunately. That includes 25% tariffs on certain autos and parts, 50% on steel and aluminum and copper. The biggest chunk of those tariffs, steel and aluminum, hitting quite heavily, partially because Canada is the largest supplier of both steel and aluminum to the United States, largest foreign supplier of steel and aluminum. And of course, 50% is a very big number. And then of course, the auto industry getting hit with those 25% tariffs as well, because we know that over the last 50 or so years, the North American auto industry has just become more and more heavily integrated across the Canada-US border and the US-Mexico border. And so, of course, all of that heavily integrated trade now results in tariffs, or at least having to check if something is eligible for a tariff, what rate that tariff is, every time a part or a larger piece of many parts goes across the border. So those are kind of the three main areas in which the Canadian economy is currently being hit: steel, aluminum, and autos. Now, Canada, for its part, kind of announced retaliation, announced that we would kind of expand our retaliation, and then kind of pulled back on that retaliation. So effectively speaking, we have very minimal retaliation right now on US goods, although we do still have 25% tariffs on US steel, US aluminum, and the content of cars coming into coming in from the United States into Canada. So that's, again, kind of the big picture. I'm not going to focus on, again, all of the details in this slide either. I just want to point out a couple of things. One, this is from a US perspective. The average tariff rate that the United States is charging for its imports has skyrocketed. So you can see that in the graph here. It's, we're back to essentially 1920 levels. But I do also want to highlight a specific part of that graph, is that little line there, the red part of that blue line, it's actually showing a little bit of an increase, quite a bit of a notable increase actually, since the US signed a deal with China. That is very key, and it shows you kind of how important Chinese-US trade is to the US economy. Essentially, China is so important, and also the tariffs that were applied on China before May 12th were so large, they were in the triple digits, that now that they have a trade deal that, at least it's not a deal, it actually just kind of delays the implementation until they get a deal until November. That in and of itself, that delay, bringing the tariff rate down from 125% to now 30%, changed the average effective tariff rate so drastically. So that's kind of two things to keep in mind. One, the tariff rate for the United States skyrocketed just compared to last year. Two, China is very important. Number three, the other kind of piece of the puzzle is a lot of these tariffs that the US is applying. I'll get to which one specifically, but most of these tariffs come under this legal provision, and I'm not a trade lawyer. I apologize to all of the lawyers that might be on this call. I'm not going to sound very specific because, again, I am not a lawyer, so I don't have to. But a lot of these, the justification for a lot of these tariffs is under this argument for national security. That in and of itself has been challenged, appealed, challenged, appealed, challenged, and essentially it's going to the Supreme Court at this point. So it is unclear on whether a lot of the tariffs that the US is actually applying right now are going to last, and if they get toppled in by the Supreme Court, whether the US has to pay that money back to any importers that have already paid those tariffs. Unfortunately, that doesn't really impact Canada. So whether those tariffs are struck down by the Supreme Court or not does not impact Canada because, like I said, Canada isn't necessarily facing those reciprocal tariff rates. The tariff rates that actually impact Canada are the sectoral tariffs. So those are under a whole different set of legal arguments, and so those aren't the ones that would be kind of struck down if the Supreme Court decides to do that. So that is one kind of important piece of the puzzle here is if the White House loses its case at the Supreme Court, they may decide, okay, we can't do these reciprocal tariffs. We can't apply these blanket tariffs on a number of other countries. So we're going to go drill deeper into these sectoral tariffs, which are the ones, again, that are hurting Canada the most right now. That said, right now, the way that things stand, Canada has I think Prime Minister Carney has called this the best of all the deals in the world, the best trade deal in the world. And he's kind of right, although, of course, it kind of depends how you slice it and how you want to look at it. It's not great. But we're estimating that Canada's effective tariff rate is around 6 to 7%. So that's the tariff that is being charged on what Canadians send to the United States. That's a lot lower than most of the rest of the world. Because, like I said, a lot of countries, the kind of best deal that they've been able to get with the United States is 10%. But as you can see here, there's a lot of countries well into the double digits, but even looking closer to that 30 to 40% mark. So things are going relatively well for Canada, certainly better than we would have expected in the spring, and better than a number of other countries. But of course, there's two very important things to keep in mind here. One, a lot of this is because we are insulated by the USMCA. So it's kind of putting a lot of eggs into one basket here. But also, we are probably the most heavily exposed, if not one of the most heavily exposed countries to trade with the US. So even though our tariff rate is lower, we are still getting hit quite heavily because we are so exposed to trade with the United States. Now, I'm going to put that aside. Beyond tariffs, how are we looking right now? First off, getting kind of the obvious out of the way. Second quarter GDP growth, we just got those numbers in. The economy shrank in the second quarter. That, of course, covers kind of what we would consider peak tariff uncertainty. So if you think back to Liberation Day, again, those triple-digit tariffs on China, those were eventually pulled back. So the second quarter is kind of where we would view kind of the worst of this trade impact. We did see a contraction, but we are expecting, it's very, very early, please everyone knock on wood, we are expecting that the economy did turn a bit of a corner and eked out very, very modest growth in the third quarter. So that together would imply that Canada is not in a recession, but I will caveat that by saying A, very, very early in the quarter. B, I did tell you all to knock on wood. So if we do get any sort of bad data, I can blame anyone who didn't knock on wood. But essentially, there are still some positives out here. We do have the fact that interest rates have come down. There is a lagged effect. So even past interest rate cuts are still making their way through the economy. And we do, spoiler alert, do expect the Bank of Canada to continue cutting rates. So we do think there's a little bit more support coming through the pipeline. We do have the fact, and I will get into a little bit more detail, but we do have the fact that balance sheets do remain quite healthy. That is kind of helping to support some consumer spending. And we do have two governments on both sides of the border, Canada and the US, kind of willing to spend. And that does also help support the economy. So just for comparison's sake, we do have national Canadian growth rate at 1.2%. US we have at 1.7, so still a bit stronger, and you can see that they have been outperforming for the better part, essentially the entire post-pandemic period. But both growth rates are below where we would kind of expect normal potential long-run growth rate to be, which is closer to 2%. So it's not great, but given the circumstances, again, likely not, knock on wood, a recession in Canada, which again, we are kind of moving past this worst case scenario. So if we can get through this relatively unscathed, it's a little bit better than where we would have thought we would be back in the spring. Now, I did mention this very briefly, but there is this kind of divergence between Canadian and US growth. A very important driver of this divergence has been the difference in population growth over the last few years. And this, I would say, is probably would have been the biggest story in the economy before the trade war. And without the trade war, it still would be the biggest story of the Canadian economic landscape. And that's because our population grew just by rates that you wouldn't expect any developed nation to see over the last few years. Now, this chart on the right has a growth rate on a 5-year basis because we kind of tried to smooth out some of those spikes. But on a year-over-year basis, population was growing above 3% year over year, which is the highest we have seen since the tail end of the baby boom. So that's, again, something we haven't seen in generations. Of course, it's going to have a very large impact on any economy, such sudden immigration flows. But essentially what that means, just from an arithmetic, mathematical basis, very basically means if GDP is, growing modestly but not keeping up with population growth, that means that real GDP per capita, so real GDP divided by the number of people, of course, goes down. And so that is the graph on the left. You can see, of course, the blue line vastly underperforming the green line, which is the US real GDP per capita. The reason why that is important is because that's kind of a shorthand way that we use to measure the standard of living. And so when I say things like, Canada's not in a recession right now, Canada wasn't in a recession coming out of the pandemic, we never got those 2 straight quarters of contraction, that's all well and good, but for, the everyday person out there, they don't necessarily care what the economist in Toronto is saying about a technical recession. They're seeing their living standards fall. And this is a good way of kind of visualizing that is, regardless of what the data says, people out there, of course, struggling with high inflation, struggling with the fact that, they may be competing with many, many more people to, find a job or to get a placement at a university, things like that. And so again, this is kind of one of those big picture themes that I hope you all carry with you through the rest of the presentation, because I think it is very important. I know the news spent a lot of time talking about this, but unfortunately it's kind of been pushed under the rug now that we have these new immigration targets. And of course, the trade war is kind of taking up a lot of oxygen, but this kind of trend is still there. And the last piece of this trend has been, of course, the fact that the Canadian government has tamped down on these immigration inflows. And so a lot of these people that were coming in were international students in particular. And so we did announce new tighter measures on international students, on non-permanent residents more generally. And so we've seen those population flows slow quite dramatically since the tail end of 2024. And so again, swinging from one way, now swinging to another. So again, it's still having that impact on the economy as we look forward. Last piece here, I did mention household balance sheets doing relatively well, and that's kind of keeping some support for consumers. But I do want to point out that Canadian households do remain one of the most highly interest rate sensitive household sectors across any developed world economy. And so what that essentially means, Canadian households, very, very sensitive to changes in interest rates, very, very sensitive to pulling back when rates were rising in 2022, and also very sensitive now that rates are falling in 2024, 2025, and possibly 2026 as well. And what that boils down to is the fact that household debt levels are quite strong, again, stronger or higher than they are in the United States, higher than they are in any comparable country. And most of that debt is, of course, in mortgages. And so we're seeing a little bit of a pullback in mortgage demand from record highs a few years ago. So that is good in the sense that it is, of course, giving households a little bit more breathing room. And of course, makes sense. Rates were rising, fewer people buying houses, less demand for mortgages, but it does remain quite elevated. Even though it has pulled back, it is still quite higher than, again, those comparables in the United States. So again, something to watch as well as rates continue to turn and hopefully continue to fall. Now, as we take a step back, looking at the country as a whole is all well and good, but then we, of course, kind of touched on this, but there are very, very different impacts and very different outlooks as we're kind of turning the page into the tail end of 2025 and into 2026. Now, I mentioned, of course, the trade war being the largest kind of looming effect on the Canadian economic outlook. It very, very much depends on where in the country you are, what sectors you work for, and those two things are kind of related, just given how this country is built. So we did just a very quick look at, how exposed each province is to the trade war or to these increased tensions with the United States. This is literally just looking at the share of exports to the United States as a percentage of each province's GDP. Now you can see that very clearly. I think Alberta stands out immediately. They have the highest share of exports to the United States, but most of those exports are in energy. So that's kind of the green part of that bar graph. And energy is kind of a unique case because a lot of the US consumers that are buying Canadian energy have very, very few alternatives to Canadian energy, whether it's geographically in terms of the actual quality of energy or just in terms of price. And so energy is a bit more insulated from the trade war. It also only has a 10% rate, and that's only if it doesn't fall under USMCA exemptions. So again, if we put that aside, just look at the blue part of that bar graph, I think it's pretty clear that central Canada is kind of the biggest source of that risk. And then again, if you kind of drill down past the absolute exposure and start looking at, steel and aluminum, for example, have the highest rate of just of 50%, tariffs, and you see that central Canada really is where kind of that weakness lies, especially in Quebec, which is kind of the heartland of steel and aluminum. But of course, that doesn't mean that Quebec, Ontario, Manitoba are the only provinces dealing with this. New Brunswick also stands out quite heavily. New Brunswick, Newfoundland, of course, having quite high exposures to energy exports as well, so that kind of helps. But those blue bars are still there. New Brunswick, PEI, quite a bit of manufacturing that is still, again, exposed to trade in the United States. So that's kind of one way in which to look at, how all of this trade drama or, these headlines that you see in the news actually have an impact on the country. That's not to say that provinces like Alberta, like Saskatchewan, aren't impacted. Of course, there's also that psychological impact, sentiment impact weighing on investment. But we still see that, at least in our view, Alberta, Saskatchewan, for example, still leading the pack in terms of economic growth, according to our forecasts this year and next year, because they are less insulated. At the other end, we see Quebec down there, we see New Brunswick down there, and you're really seeing that trade impact start to play at that divergence. Now, for the Atlantic region as a whole, we do have GDP growth actually bang on the national average, coincidentally. So just over 1% growth expected this year. But again, there is a huge variation in amongst the provinces, and there will continue to be really into 2026. And as long as these trade tensions or trade uncertainty lasts, unfortunately, we don't know how long it's going to last, but we do have it continuing to play an impact into 2026 at least. Now, what does all of that mean for different parts of the economy? Great question, Shelley. So, of course, there's a huge story here for when we're looking at things like the job market, not just the fact that the pandemic really skewed the picture. Obviously, that it changed the whole scale of this graph, but also we have this, population surge, this historic population surge. All of these people coming into the country can't create enough jobs to keep up with the number of people looking for jobs because there are so many more people. And so there's a lot going on here, but what I essentially want to say is it's both the fact that rates were very high for very long. The Canadian economy is much more sensitive to those higher rates. Now we're getting rates lower, but we also have this trade impact kind of outweighing everything. And so there's quite a lot kind of resulting in a much softer job market. It is coming from a period of historic tightness. Now, if you think about, 2022, 2023, when workers, were talking about quiet quitting, when people were talking about, if they call you back into the office, you can just find another job. That's because it was historically a very, very good time to be an employee. The job market was very, very tight. And so employees had a lot more leverage. Now, not so much. So now we've gotten to the point where, nationally speaking, the jobless rate is above 7% for the first time in about a decade outside of the pandemic. And so that is one area where we are watching quite closely. The Bank of Canada is watching quite closely, and is essentially kind of drills down to the heart of where this weakness lies in the Canadian economy, is through the fact that people can't find jobs. And again, if you drill down into the different details of all of this data, you'll see youth especially can't find jobs. The youth unemployment rate is about double, more than double the national average. You can see people in, especially in manufacturing, cannot find jobs because, again, very, very sensitive to these trade disruptions in terms of autos manufacturing, steel and aluminum manufacturing, even things like copper, that's all manufacturing as well. So very, very different story depending on where you are in terms of sector and also in terms of geography. Again, you can see the province is very, very varied in terms of where their unemployment rate lies. But just to highlight, Newfoundland and Labrador does remain the highest, does continue to have the highest jobless rate in the country. That's not particularly surprising. Alberta does also remain quite high. Prince Edward Island, Ontario, New Brunswick, looking at the high 7%, going into 8%. And so that is kind of where we're seeing a lot of that impact. Again, it's not just trade here, it's also the past pandemic skewing of the labor market picture, but also the past population growth that is also having an effect here. So it's not just a trade war, it's not just looking ahead. It doesn't necessarily, again, I just said that Alberta is one of the strongest provinces in the outlook. And so the fact that they have the highest jobless rate doesn't necessarily contradict that story. It's just, again, reflecting a lot of those past trends that we've seen already. Now, another very important part of the economy is, of course, inflation. So we just talked about the labor market, fewer people having jobs, maybe potentially more layoffs, fewer job openings. So if you're trying to apply for a job, you're less likely to find one, or at least it will take longer. You might not find one in your, desired sector or necessarily for the desired wage. So if fewer people have good jobs, or at least have a job, they're going to be spending less money. And so that means less demand for businesses selling their goods and services. They might want to raise, at least lower their prices, or not raise them as quickly as they had been. So, of course, inflation, huge, huge, huge buzzword for the last 5 or so years, and for good reason. It had spiked to over 8% year over year. Which was the highest that we had seen in at least a generation here in Canada. It has now come down. So, for reference, the Bank of Canada's inflation target is kind of where they want to keep inflation on a sustainable basis, is around 2%. So, going from 8%, we have now brought headline inflation down to 1.7%. Typically, you would think that's good news, right? Inflation is below target. Maybe we want to start cutting rates even further to kind of stimulate demand, to kind of bring inflation back in line to 2%. But a lot of what is bringing inflation down, actually, the number one driver is the fact that the carbon tax was cut in a large portion of the country. And so that's bringing energy prices down. When you take out one-time factors like the carbon tax being removed, but a lot of other one-time factors, a lot of anomalies month to month, underlying inflation is still quite high. So we're looking at rates closer to 3%, the low threes, high 2 percentage points. And so that is what the Bank of Canada is actually worried about. So even though inflation is below 2% on a headline basis, they're really looking at those details to see what is actually pushing inflation up and what's pushing it down. And what does that mean for kind of the underlying fundamental price pressures. And unfortunately, what we're seeing is it's still quite sticky. So we do actually have a revised data or updated data coming out for August in a couple of weeks, but so far this is still what we're seeing. We do have some progress in things like house prices, which are the biggest driver just in terms of weight in the CPI. That's an index. And so they've got a number of weighted components, housing being the biggest, because if you think about your day-to-day lives, your rent, your mortgage, it's taking up the largest portion of your budget. And so where housing goes, that kind of is a major driver of where overall inflation goes. Thankfully, house prices coming off those record highs, it does take time for that to happen. So we're still seeing some progress there, just from those records hit years ago at this point. But again, that progress is still ongoing, and so it's still higher than where we would like to see it, but it is helping bring inflation back down to target. Now, speaking of housing, as we drill down into exactly what we're looking at right now, of course, the market, as well, everyone on this call knows, very much in flux, but in a weird kind of flux right now. So, on a national basis, we're kind of seeing a soft market, but again, it very much depends where you are in the country. So, this graph on the right is kind of one way to look at things. It's just how prices have fared since the peak in 2022. Of course, we saw a big market reaction after the bank started raising rates. And so, how have things gone since then? Now, I'll start at the bottom just because that's kind of an easy story to tell. On one hand, we see Toronto, we see London, Ontario, not the UK, we see Hamilton, Burlington, Kitchener, Waterloo. Those are all mid-sized to large cities within Toronto, within Southern Ontario. Those are kind of the outliers when we're talking about the national story. Those, again, prices well down, still well in the double digits. That is reflecting the fact that affordability does remain quite challenged. That also reflects the fact that during the pandemic, so on the way up until 2022, those prices had been skyrocketing much faster than anywhere else in the country because people, again, were trying to leave Toronto. It's expensive, but also I don't have to go into the office because of the pandemic. And so, again, that's bringing all that demand in. So there is naturally going to be a release as well. Now, if you take those areas out, again, Canada skewed a little bit due to the fact that Toronto and Southern Ontario have that high population. The rest of the country, Vancouver, Ottawa, Victoria, still down from that peak in 2022. Those are places that still have relatively high unaffordability, or still have those affordability challenges still weighing on potential home buyers, keeping them on the sidelines. On the opposite side of the spectrum, we've got Calgary, Montreal, Edmonton, Regina. So a lot of those you can tell, obviously, in the West. They've got that affordability factor kind of helping them, but also the fact that, again, they're a little bit more isolated, their economy doing fairly well. We know energy prices spiked in 2022, for example, so that helps the economy in Alberta, in Saskatchewan. And that has been helping kind of buffet these. So it's kind of an important thing to remember when you look at things like this. It really depends exactly what the growth rate is. So again, like I said, this is from the peak in 2022. And so this is capturing a lot of those changes since 2022. So we're talking about, everything from those pandemic era swings to oil price shocks in 2022 to things like affordability, which still remains kind of the driving force between a lot of this regional divergence. Quick snapshot here, Ontario being one side of the ledger on that weakness in terms of affordability. Sales activity is still well below the 10-year average, it's still quite soft. Whereas a place like Atlantic Canada, this is the region as a whole, almost bang on the 10-year moving average. So it's essentially after spiking, thanks to that affordability, kind of helping keep some demand in the region, or at least bringing some demand from outside of the region into the region. We're starting to see some release, so a little bit more stability, but again, still doing much better than a lot of those other softer regions in the country. Another way to look at that is just a way to measure exactly where we are in terms of buyers or sellers market. This is just the sales to new listings ratio. As you all know, there's a number of ways to slice and dice this data. This is one of the ways. And again, I should mention this is data as of July. We are getting new data from CREA for August next week, but this is what we've got so far, so halfway through the summer. And again, there is still a bit of a regional divergence. So nationally speaking, we would expect, or we would kind of characterize the national housing market to be roughly in balance. But again, we are seeing kind of going from west to central to east, a lot of those regions that still benefit from relative affordability. I don't want to go out on a limb here and say that it's fully affordable, because I know it's not, but relatively speaking, still benefiting from affordability, keeping some demand either in the region or bringing demand from outside of the region into the region. So we've got people, again, Regina, Edmonton, Winnipeg, those were much higher on that scale of being sellers markets, much hotter just a few months ago, kind of coming down a little bit. And same idea for the Atlantic provinces. You can see most of those cities and provinces still firmly in sellers market territory, but not as much as they were just a few months ago. Again, kind of coming off, but still relatively firm compared to the rest of the country. And I've kind of alluded to this, but when we're talking about the population story, there's kind of two things actually going on here. One of the things I talked about was that strong inflow of immigrants into the country, and people were going into every region, seeing those very strong flows, essentially historic flows of people coming from outside of the country. Second thing being people moving within the country. And a lot of that has kind of come to the forefront now that we have those tighter immigration controls. That story is now not overshadowing that regional picture. And so again, I'm not going to touch very strongly on this, but essentially we're seeing people largely move out of Ontario and to a lesser degree move out of BC, largely going to Alberta and to a lesser degree to Atlantic Canada as well. And so that's why those regions do remain kind of the more obvious ones when you look at the national picture as the ones that still remain those sellers markets, because there still is that demand for housing in those regions. Now, again, won't touch on this a lot because the story is kind of ho-hum, which is nice to see. Not something we've seen very often recently in Canadian housing, but we are essentially expecting affordability to kind of remain the driver, weighing on what would otherwise be this, broader recovery on lower rates. So on one hand, we have lower rates kind of helping to support a recovery in the housing market. On the other hand, these affordability challenges, but also just, the fact that we don't know necessarily what this trade war is going to look like. We don't know what the economy is going to look like 6 months from now, a year from now. And so that is also weighing on buyers' minds, on investors' minds, because at the end of the day, mortgage rates could be zero. But if I'm worried about not having my job in a month, I might not necessarily want to buy a house, right? So that is kind of the upside and also downside to the Canadian housing outlook. And so that's why our story is essentially a little bit more of a stable but prolonged story in terms of the actual forecast for the housing market looking on from here. Now, touched on this, but this is kind of the meat of what we do. What exactly is going on with interest rates? Now, of course, we've seen rates come down from that historically aggressive tightening from the Bank of Canada. We are expecting another rate cut coming out of next week's meeting. That is kind of a controversial take right now. Not everyone agrees on Bay Street. We are expecting rates to come down in September, so next week, and again in December, and then again in the early part of next year. So we are expecting the Bank of Canada to kind of stop its easing cycle with rates at 2%. The overnight rate right now is at 2.75. So we still got, again, 75 basis points of cumulative easing still coming through the pipeline. And so that should still help not just the housing market, but broader economic growth and the recovery overall. Again, very controversial in the sense that a lot of things are in flux. We still have, again, inflation, underlying inflation remaining quite sticky. That puts a little bit of a hawkish lean on kind of what the Bank of Canada is thinking. But then on the dovish side, kind of the side arguing for more rate cuts, would be the fact that the labor market, again, is quite weak. We're at a national unemployment rate of 7%, and GDP is still quite soft, still well below potential. And so that is kind of what the Bank of Canada is thinking about. That's what a lot of central banks are thinking about. Again, won't touch on this for too long, but we do get a lot of questions on what exactly the loonie is looking like, and I'm happy to take any additional questions, but in the interest of time, essentially kind of another easy story in the sense that we do expect a little bit more stability at current levels, maybe a little bit stronger than what we're seeing, just once the Fed also starts cutting. So we do think that the Fed is also going to cut next week. They have a meeting the same day as the Bank of Canada. And we do think that that will also help kind of bring investors back to other currencies outside of, those traditional safe haven assets that are the greenback, that are things like gold, bringing some more investors back to the Canadian dollar. But of course, this bigger question of what exactly the trade relationship between Canada and the US looks like is really what's going to drive this longer term story for the Canadian dollar. Because again, if US investors don't necessarily see those incentives to invest in Canada, they're not going to necessarily want the Canadian dollar in order to do so. And so that will, of course, be this kind of overarching cloud on the value of the loonie. So wrapping things up, I'm going to take a breather and happy to answer any questions.
Shelley, that was awesome. I love ending with the Bank of Canada and some potentially good news coming here. A lot of the people on the call, again, we're in the housing industry. We have lawyers, we have realtors, we have mortgage brokers, and we have some of our friends from the insurers. I think I saw a couple people from Canada Guarantee, Sagen, and CMHC on our call. So I'm sure that's very, hopefully, positive news for everyone. We did have some questions, and I've written a couple down, but I'm going to throw to Amanda. We had a couple questions in advance of our call, and we'll start with that, and we'll go through the questions that we received during the call, and then we'll open it up. So Amanda, go ahead.
Great. So one that we received was, as a potential first-time home buyer, with the prices being where they are, what is the best time to buy? So should we buy now because the prices will keep rising, or should we wait because the stats predict it will start to lower?
Yeah, so again, it kind of depends on your individual kind of financial circumstance. So unfortunately, that's, I know, a bit of a cop-out answer, but I can't give you specific financial advice because of all those kind of little nitty-gritties that may affect your decision. What I can say, again, is it really does depend on where you are. So as a millennial living in Toronto, I'm just going back to this regional picture. I've got, a lot of people trying to buy condos right now because condos are kind of one of those areas of particular weakness, just on a national basis. But really, if you're in a place like Quebec City, for example, that's the hottest housing market in Canada, maybe not the best time because, again, very firmly in seller's market territory. That said, I mean, of course, rates are continuing to fall. A lot of that has already been priced in. So again, that's kind of where you have to look at, what rates you're getting, what your specific financial situation looks like, what kind of house you're looking into, because again, those segments really matter. I just mentioned Toronto condos being kind of the particular weak spot. But yeah, it's kind of a big picture story, but also a story specific to you. So big picture perspective, I will just point out segments and regions kind of being the biggest drivers right now of exactly where you need to look.
The bulk of the folks on our call are from Nova Scotia and New Brunswick, and it seems, from what I'm seeing, are some of the more steady regions across the country. We've been, slightly insulated on what's going on, obviously in Ontario. For me, before I came on the call, I thought things were as bad in BC as they were in Ontario, but it seems like Ontario is that big call out. We do have some investors here that are some of our clients are dealing with that are buying condos in Toronto because everything's 25% off. I don't know, based on the data that you're seeing, is it the floor in Ontario? And once the rates really start softening, are things going to start renormalizing in Ontario?
Yeah, I mean, I wish I could tell you because again, I'm a millennial in Ontario, so I wish I knew. We are currently expecting the floor to be around now-ish to maybe middle of next year. There's again a lot of kind of weird quirks in Ontario, specifically in Southern Ontario. We've got the affordability thing, but like you mentioned, so does Vancouver. Ontario and BC are also the ones that are both on an absolute and on a relative basis, the provinces and regions most heavily impacted by that swing in immigration. Again, first the inflow, now a lack of people just looking for places because of that tightening of immigration curbs. But also specifically, Toronto has a little bit more space dealing or at least to work with, versus a place like Vancouver. Toronto also has a lot more exposure. Southern Ontario, actually, I should say more broadly, has more exposure to the trade war. If you think about those auto plants in particular, than a place like BC, which has, yes, some exposure, but also has a lot of exposure to markets in Asia. So again, there's a lot going on here, and again, it does depend on what segment you're talking about. So, like you said, condos quite cheap right now, likely going to remain so, because we do know that a lot of that is just coming from the fact that investors and buyers are kind of staying on the sidelines, because most of the condo market is, students, young professionals. Those are the people most likely to be affected by, either job cuts or, again, those curbs on international students. And so we don't expect that tide to turn until the middle of next year. But again, it all kind of boils down to what's going on with the trade war. But yeah, that's kind of where our fundamental forecast is right now.
That's interesting. I know in Atlantic Canada, we've had some really amazing population growth, which also comes with its challenges. I think in Nova Scotia, we were always used to, a big, upsurge of new to Canada, but they hadn't so much experienced that in New Brunswick. And I would say the population growth, in some of the major centers in New Brunswick, as a percentage, has been even higher than Nova Scotia. I wonder how things are going to be impacted now with less new to Canada folks coming. Is that going to start slowing the growth in both Nova Scotia and New Brunswick?
Yeah, so you hit the nail on the head. So it's the fact that, yes, there are fewer people that are new to Canada. There's also the fact that, yes, there is that relative affordability picture still helping folks in New Brunswick, still helping folks in Nova Scotia and the rest of the Atlantic provinces relative to the rest of the country. But, if you're relatively affordable, but you're still rising really quickly, then that, gap starts to narrow a little bit. And then there's this other big piece that I think we unfortunately have very, very terrible data on. StatCan doesn't track this. But the question of, how many people that came into the country over the last few years are actually going to stay. So whether they're staying in the province of their choosing and going somewhere else, versus actually leaving the country to go either back to their home country or to a third country. That, I think, is a major piece of the puzzle that it's very unfortunate we don't have the data to track that, because a lot of, again, that the biggest chunk of people that were coming into the country were non-permanent residents. And so you would naturally suspect that they would have, less of an attachment to staying here long term, especially if they can't find a job, especially if they can't afford a house. So that is another piece of the puzzle that I would be very curious to see. Unfortunately, again, we can't really predict that, or at least quantify it, until we start to see that on the ground. And that's something that I think we'll start to see starting now into the next couple of years.
We have some of the lowest cost of real estate on average across the country, but I'm curious to see, how does that income pace with the cost of real estate? I think a lot of millennials here feel that we've had such crazy price growth over the last 4 and 5 years, where before we had 1, 2, 3% growth per year. So like what we're seeing today, I think feels pre-2019. I'm not sure the income's paced as much as the, cost of housing.
Yeah, and I think you hit the nail on the head. Unfortunately, I don't have an affordability chart here, but it is quite similar to what we're seeing right now, just the market balance. It is quite heavily correlated to house prices, not just absolute house prices, but as a share of income as well. So a lot of that story does still come to play. But then when we're talking about things like, over time and over generations, that's where things get a little bit stickier. So as we know, it's obviously affordability. It's not just affordability of buying a house. Even if incomes kept pace with house prices, which they did not, there's still the fact that, groceries are a lot more expensive, things like that. So of course, your budget is getting eaten away by other things as well. So there's that piece. So yes,
It's not
affordability
just
has
housing. It's the pub
exactly.
and the grocery store that's eating into the
Yeah,
budget.
and rent. I will
And
also
rent for
say, yeah.
sure.
So
The
yeah,
rents
it's
are
not just
the rents are very high, I think, in Halifax. I think the average 2 bedroom in Halifax is now about $2,500. So that would
yeah,
be very similar to what bigger cities, cost of housing would look like from a
exactly.
rent perspective. So I think in
Yeah.
Nova Scotia and certainly New Brunswick, home ownership in many cases is more affordable than being an actual renter. So, the homeowners are maybe getting rich and the renters are staying renters in, I think, a lot of these cases. We did have a question from the chat that I want to get to, Shelley. This was from Steve McClellan. He said Nova Scotia had the lowest GDP in all of North America. What was the big change here?
I'm just gonna go back here so we can have a better visualization. Yeah, so I want to say that was a couple of years ago, and you can correct me if I'm wrong. So there's a part of a weight from weaker tourism flows and all of that. Nova Scotia has been one of the better beneficiaries of that recovery in tourism, not just pre-pandemic, dropping those lockdown restrictions, but also this Buy Canada or travel within Canada movement that we're seeing now. Of course, being the largest province in the Atlantic region, there's also one of the largest beneficiaries of that past immigration flow. Those people, again, to some degree, don't exactly know exactly how much, but to some degree, staying within the province, helping to support the housing market, things like that, helping to create jobs. And all that at a greater degree than in some other provinces that may not have seen the same magnitude of flows. But on a relative basis, I mean, you can see here that we do have Nova Scotia kind of middling both this year and next year, and that's kind of the helping hand of that recovery from the pandemic has started to dissipate. And we also have the fact that, yes, there is about some exposure to the trade war, but not necessarily as bad as the New Brunswicks of the world. So yeah, it's kind of a middling story right now, both from the immigration perspective and also the trade war perspective.
I think in the middle is okay, and I think for many years it was balanced and it was in the middle. We didn't have the big boom, and we didn't have the bust. And, I think stability, there's something to be said that is okay. And I think we're feeling more in a balanced market here from a buyer and seller's perspective, at least in residential real estate, than we have in several years. I'm here for it as someone in mortgage lending, and I hope our realtor and lawyer partners are here for it as well. Talking back to 2020, it was very challenging, just with that level of demand. We talked a lot about the Bank of Canada, and hopefully we're going to see 75 basis points in price reduction or cost of borrowing between now and into next year. Can you speak to what's going on with fixed rates? And I know that sometimes can be a can of worms. We've been watching the bond market, and it seems like overall banks are very quick sometimes to increase the fixed rates, but as the market kind of softens, they're not as quick on the way down. Can you kind of share any insight on what we're going to see kind of from the bond market perspective, this year and into next year?
Yeah, so I mean, as you touched on, I think the bond market is a little bit stickier than what we would see in other markets like FX or in equities. A lot of that is because I do think there is some element of investors kind of looking further ahead than what we would see in some other markets. But a lot of that is also because we are dealing with a lot of political instability, especially over the last few days. I don't think that's fully captured in this graph, but anyone who's been seeing the headlines knows that there's been quite a bit of volatility again over the last week or so. That is coming from fiscal, kind of these global fiscal concerns. So we've got, for example, the government in France just getting toppled by a no confidence vote, PM getting removed, Macron now having to name his, I believe, fifth prime minister in the last less than 2 years. So quite a bit of instability there. We've got some fiscal concerns coming out of the UK. They've got a budget coming out in November, I believe. We've got fiscal concerns in Japan. Their prime minister just left ahead of a no confidence vote in which he likely also would have been voted out as well. So there's a lot going on outside of Canada, but also specifically in the United States. We've got this kind of fiscal problem. It's almost like Schrodinger's fiscal problem. So if you think back to the last few years, we hear about hitting the debt ceiling until we don't. And then it's like, okay, well, the debt ceiling was lifted, and then it's suddenly a new crisis again until it's not. And so this kind of ongoing issue has also been kind of at the forefront, especially after the US was recently downgraded over the last year or so by a number of ratings agencies. And so all of that is kind of coming to the fore, especially recently with a lot of these global problems. And so Canada is kind of being caught up in the wave a little bit there, even though rates, and you can see Canada, US here, policy rates at least have been lower in Canada compared to the United States, as well as compared to a number of other countries. So despite all of that, again, there is kind of this bigger picture narrative driving bond markets more broadly.
And I think, we had some pent-up demand here. I think when the rates were high, when we were seeing rates in the 6 and even edging up almost to that 7% mark, some folks were sitting on the fence. And I think we saw some of this demand clear out last year and into this year. We're not maybe seeing these transactions, but, at least for our team, we're up 40%. And I think maybe consumers are needing some more of this advice when they're, we're talking about this renewal cliff that kind of didn't happen. We see a lot of these borrowers that are coming up for renewal have rates at, 169, 199, 249 that are renewing into rates oftentimes in those low fours. Can you speak to, what's going on with those borrowers? Like, are they changing the mortgages, extending the amortization? Are they choosing to sell? Like, we haven't seen this mass new listings really hit the market, at least in our region.
Yeah, I'm just gonna go back here. So there's a couple of different things happening, and you touched on some of them. I'm just gonna go back here. So this is just debt service ratio on the right here. This is just one of the ways on a macro scale that we kind of think about the stress on household budgets. So debt service being mostly mortgage payments, obviously coming down as rates came down. So when we were talking about the kind of renewal cliff, I think to some degree, yes, there is still some upward pressure, although again, it's not as bad as we would have expected a year or so ago, partially because rates have come down, I think, a little bit faster than people expected. Reason for that being Canadian households quite resilient, quite responsive to changes in interest rates. And so the Bank of Canada was able to lower rates a bit faster and earlier. But also because now we have this trade war weighing on the economic outlook, weighing on the labor market, and therefore prompting the Bank of Canada to cut a little bit more than we would have expected. So that has kind of taken the wind out of the sails of this upward pressure, even though it is, rates are of course still higher than in 2020, 2021. Again, not as bad. When we think about some other marginal policy changes, of course, the stress testing rules, but also things like, the higher amorts for first-time home buyers, things like that, helping a little bit at the margins, but we really do think that it's kind of a fact that rates aren't as bad, or at least aren't as high
As
as
they
we
had been.
expected them. Yeah, and then there's also the fact that, people still have jobs on the whole. Again, I just talked about how soft the labor market was, but it's not as bad as we would have expected in a typical recession. Again, probably not in a recession right now, knock on wood, but that is also kind of helping keep kind of stopping us from hitting the floor in terms of actual, delinquencies or things like that.
Sure. Shelley, thank you so much. And thank you to the whole BMO team and Colin for putting this together. BMO Brokerage has been a great partner for us. And, I really thank for everyone who came on the call, everyone who supported Centimum Lenders and for the last 20 years and this year, being our best year ever. We really want to give back as much information as we can and add value to you. I think where there's value, there's money. So I really appreciate it, Shelley, for you taking the time to put this together and sharing your insights with us. When we send out this invite, we might have incentivized people to come on the call because, not everyone wants to hear about economics for an hour. We're going to be giving away an Air Canada gift cards. We're going to run a little lottery here once we get off our call and get all of the attendees into our system. So I'll be in touch directly for the recipient of our Air Canada gift card so someone can go somewhere. And I just want to thank everyone. A lot of great questions that came through. And for me, I'm a little barstool economist. I get to give my personal opinion on City News. So I'm definitely going to be tuned in next Wednesday when the Bank of Canada puts out the announcement here at 10:45 local. You'll be hearing from me on Facebook and I'll be on City News. So if anybody wants to tune in the radio, you can hear what I have to say. And I'm sure we'll echo some of Shelley's comments as well. If anybody has any questions after, feel free to reach out to us. And again, thank you so much, Shelley, and thanks, Colin and the whole team at BMO Brokerage for helping us pull this together. Have a great day, everyone.
Sure. Thanks, everyone.